Gogoro is not failing. It's reaching a point where it must change. Recently, market data and management changes have caused many people to question Gogoro's future. Sales are declining, financial pressure is rising, and consumer confidence is clearly weakening. But calling Gogoro finished misses the real issue. What we are actually seeing is a company reaching a stage where not changing is no longer an option. If Gogoro wants to survive, not only in Taiwan but globally, the problem is not whether it can sell scooters, but whether its entire system still makes sense. The electric scooter market itself hasn't collapsed. It has matured. Over the past 2 years, both Taiwan and global markets have faced the same reality. Subsidies are fading, and consumers are becoming more rational. This is no longer a growth-at-all-costs phase. It's a red ocean transition where cost structure and system design matter more than early excitement. Taiwan is a good example. Once considered one of the world's most advanced electric scooter markets, Taiwan has recently shown clear signs of slowdown. In 2025, total electric scooter sales dropped by more than 37% compared to the previous year. This doesn't mean consumers suddenly rejected electric scooters. It means the early adopters are already saturated. Without stronger incentives or meaningful technological breakthroughs, the next phase of growth depends on whether existing users stay, not whether new users are impressed. Gogoro, as the market leader, feels this pressure the most. Despite dominating sales charts, with 8 out of the top 10 best-selling electric scooter models, the company is currently undergoing financial restructuring. Its stated goal is to achieve profitability in its energy network by 2026, while also planning to launch 3 new scooter models in the same year. Being the leader no longer guarantees stability. It simply means there is less room for error. At the same time, traditional manufacturers are no longer standing still. SIM continues to dominate gasoline scooters and has begun collaborating with state-owned energy companies on battery development. KWMCO is steadily expanding its IONX ecosystem and preparing new product lines. Yamaha, while quieter, is clearly watching the market closely. Gogoro is no longer the only option consumers are evaluating. Looking beyond Taiwan, global demand still exists, especially in Asia. China, India, and Indonesia together account for more than half of global electric two-wheeler sales. Southeast Asia, in particular, continues to grow rapidly, supported by government decarbonization policies and delivery platforms like Grab and Gojek. We're also seeing increasing diversification. Beyond basic commuting scooters, high-performance electric motorcycles are gaining traction. Harley-Davidson's Livewire is one example, and more lifestyle and off-road focused models are expected after 2026. Yet one problem remains consistent across markets. Nearly half of potential buyers still say the same thing: charging and battery swapping infrastructure is not good enough. This brings us to Gogoro's core structural issue. Selling scooters alone cannot support the massive cost of an energy infrastructure. Battery swap stations are not software products. They require land, maintenance, depreciation, and constant capital investment. With the current user base, roughly 600,000 riders, monthly subscription revenue struggles to cover the ongoing cost of the network. The business model itself must change. The first adjustment is maintenance. Today, Gogoro relies heavily on proprietary parts and factory-bound servicing. This makes ownership feel expensive and restrictive. Many consumers feel that buying the scooter is easy, but maintaining it is not. Opening a certified third-party maintenance system, similar to authorized workshops in the automotive industry, would immediately lower ownership barriers. Standardizing non-core components such as brake pads, tires, and lighting would allow third-party suppliers to enter the ecosystem, reducing costs and repair time. Customer retention is far more valuable than protecting service margins. The second adjustment is collaboration. Gogoro does not need to carry the battery infrastructure alone. Expanding partnerships through the PBGN Alliance and selectively sharing battery standards with trusted manufacturers would significantly increase network utilization. More compatible vehicles using the same swapping system means higher station efficiency, fewer idle batteries, and shared infrastructure costs. This is not about losing control. It is about buying long-term sustainability. The third adjustment is pricing. High monthly fees, pay even if you don't ride subscription models, and confusing setup charges create psychological resistance. Even when the total cost is reasonable, the structure feels unfair. A tiered pay-as-you-use system, such as 0 to 100 kilometers, 100 to 200 kilometers, and 200 to 500 kilometers, would restore flexibility. Heavy users could still choose an unlimited plan, while casual riders regain a sense of control. Pricing design shapes trust. Finally, Gogoro may need to rethink where its profits truly come from. Scooter sales should aim for break-even or minimal margins. The real opportunity lies in cash flow management and energy services. Stable, recurring cash flow can be deployed into higher return investments, such as large-scale energy storage projects, rather than relying on a single product line to carry the entire system. Gogoro's future is not just about scooters. Scooters are the entry point. Energy services are the platform, and the next few years will determine whether Gogoro evolves into a sustainable energy company or remains trapped by the limits of its original model. This is not an ending. It is a crossroads.